2012-13 Cypriot financial crisis.
The 2012 to 2013 Cypriot financial crisis is a major economic crisis in the Republic of Cyprus that involves the exposure of Cypriot banks to over-leveraged local property companies, the Greek debt crisis, the downgrading of the Cypriot government to junk status by international rating agencies, the consequential inability to refund its state expenses from the international markets, and the reluctance of the government to restructure the troubled Cypriot financial sector. On March 25, 2013, a EU €10 billion bailout was announced in return for Cyprus agreeing to close its second-largest bank, the Cyprus Popular Bank, also known as Laiki Bank, levying all uninsured deposits there, and possibly around 40% of uninsured deposits in the Bank of Cyprus, the island's largest commercial bank, many held by wealthy citizens of other countries, many of them from Russia, who were using Cyprus as a tax haven. No insured deposit of €100,000 or less would be affected.
Context:
The United States supreme mortgage crisis in 2007-2008 led to a domino effect of negative consequences in the global economy, including the European Union. The Cypriot economy went into recession in 2009, as the economy shrank by 1.67%, with large falls specifically in tourism and shipping activity, which caused rising unemployment. Economic growth between 2010 and 2012 was weak and failed to reach its pre-2009 levels. Commercial property values declined by approximately 30%. Non-performing loans, which rose to a reported 6.1% in 2011, increased pressure on the banking system. With a small population and modest economy, Cyprus had a large offshore banking industry. Compared to a nominal GDP of EU 19.5 billion and $24 billion, the banks had amassed EU 22 billion of Greek private sector debt, with bank deposits $120 billion, including $60 billion from Russia business corporations. Russian oligarch Dmitry Rybolovlev owned a 10% shareholding of Bank of Cyprus. Cyprus banks first came under severe financial pressure as bad debt ratios rose. Former Laiki CEO Efthemas Boulatas admitted that his bank was probably bust as early as 2008, even before Cyprus entered the Eurozone. The banks were then exposed to a haircut of upwards of 50% in 2011 during the Greek government debt crisis, leading to fears of a collapse of the Cypriot banks. The Cypriot state, unable to raise liquidity from the markets to support its financial sector, requested a bailout from the European Union. Progress on fiscal and structural reforms was slow, and following a serious explosion at a naval base in July 2011, the major credit rating agencies downgraded the country's rating in September. Yields on its long-term bonds rose above 12%, and there was concern that the country would be unable to stabilize its banks.
Response: Emergency loan, 2012.
Since January 2012, Cyprus has been relying on a EU 2.5 billion and $3.236 billion emergency loan from Russia to cover its budget deficit and refinance maturing debt. The loan has an interest rate of 4.5%, with no amortization repayment until its maturity ends after 4.5 years, and no penalty if repayment at that point of time will be delayed, in the event of a persisting lack of access for Cyprus to cover its financial needs through the normal funding markets. The received loan was expected to cover all refinancing of maturing government debt and the amount needed for the government's continued budget deficits, until the first quarter of 2013. But did not include any funds for recapitalization of the Cypriot financial sector. Looking further ahead, it was generally expected Cyprus would need to apply for an additional bailout loan.
Credit rating downgrade to junk.
On March 13, 2012, Moody's slashed Cyprus's credit rating to junk status, warning that the Cyprus government would have to inject more fresh capital into its banks to cover losses incurred through Greece's debt swap. On June 25, 2012, the day when Fitch downgraded bonds issued by Cyprus to be B+, which disqualified them from being accepted as collateral by the European Central Bank, the Cypriot government requested a bailout from the European Financial Stability Facility or the European Stability Mechanism.
Request for EU intervention and agreement.
The Cypriot government was reported requesting a bailout from the European Financial Stability Facility or the European Stability Mechanism on June 25, 2012, citing difficulties in supporting its banking sector from the exposure to the Greek debt. Representatives of the Troika, the European Commission, the International Monetary Fund, and the European Central Bank arrived to the island in July to investigate the country's financial problems, and submitted the terms of the bailout to the Cypriot government on 25 July. The Cypriot government expressed disagreement over the terms, and continued negotiation with Troika representatives concerning possible alterations to them throughout the following months. On 20 November, the government handed its counter-proposals to the Troika on the terms of the bailout, with negotiations continuing. On 30 November it was reported that Troika and the Cypriot government had agreed on the bailout terms, with only the amount of money required for the bailout remaining to be agreed upon. By contrast, the IMF referred only to good progress towards an agreement. The preliminary agreement terms were made public on 30 November. The austerity measures included cuts in civil service salaries, social benefits, allowances and pensions, and increases in VAT, tobacco, alcohol and fuel taxes, taxes on lottery winnings, property, and higher public health care charges.
Eurozone IMF deal.
On March 16, 2013, the Eurogroup, European Commission EC, European Central Bank ECB and International Monetary Fund IMF agreed a EU €10 billion deal with Cyprus, making it the fifth country, after Greece, Ireland, Portugal and Spain, to receive money from the EU IMF. As part of the deal, a one-off bank deposit levy of 6.7% for deposits up to EU €100,000 and 9.9% for higher deposits, was announced on all domestic bank accounts. Savers were due to be compensated with shares in their banks. Measures were put in place to prevent withdrawal or transfer of monies representing the prescribed levy. The deal required the approval of the Cypriot Parliament, which was due to debate it on 18 March. According to President Nikos Anastasiades, failure to ratify the measures would lead to a disorderly bankruptcy of the country. The Russian government blasted Cyprus's bank levy, piling more pressure on Nicosia ahead of the parliament's vote on the bailout. Russia had not decided at the time whether to extend its existing loan to Cyprus. With the background of large demonstrations outside the House of Representatives in Nicosia by Cypriot people protesting the bank deposit levy, the deal was rejected by the Cypriot Parliament on March 19, 2013 with 36 votes against, 19 abstentions and 1 not present for the vote. On 22 March, the Cyprus legislature approved a plan to restructure the Cyprus Popular Bank, its second-largest bank, also known as Laiki Bank, creating in the process a so-called bad bank. On 25 March, Cyprus President Anastasiades, Eurozone finance ministers, and IMF officials announced a new plan to preserve all insured deposits of €100,000 or less without a levy, but shut down Laiki Bank, levying all uninsured deposits there, and levying 40% of uninsured deposits in Bank of Cyprus, held mostly by wealthy Russians and Russian multinational corporations who use Cyprus as an offshore bank and safe tax haven. The revised agreement, expected to raise €4.2 billion in return for a EU €10 billion bailout, does not require any further approval of the Cypriot Parliament, as the legal framework for the implied solutions for Laiki Bank and Bank of Cyprus has already been accounted for in the bill passed by the Parliament last week. When the final agreement was settled on 25 March, the idea of imposing any sort of deposit levy was dropped, as it was instead now possible to reach a mutual agreement with the Cypriot authorities accepting a direct closure of the most troubled Laiki Bank with remaining good assets and deposits below EU €100,000 being saved and transferred to Bank of Cyprus BOC, while shareholder capital would be written off, and the uninsured deposits above EU €100,000, along with other creditor claims, would be lost to the degree being decided by how much the receivership subsequently can recover from liquidation of the remaining bad assets, while as an extra safety measure, uninsured deposits above EU €100,000 BOC will also remain frozen until a recapitalization has been implemented with a possible imposed haircut if this is later deemed needed to reach the requirement for a 9% Tier 1 capital ratio. The targeted closure of Laiki and recapitalization plan for BOSI helped significantly to reduce the needed loan amount for the overall bailout package, so that EU 10 billion was still sufficient without need for imposing a general levy on bank deposits. The final conditions for activation of the bailout package was outlined by the Troika's MOU agreement, which was endorsed in full by the Cypriot House of Representatives on April 30, 2013, and include: the Cypriot debt-to-GDP ratio is on this background now forecasted only to peak at 126% in 2015 and subsequently decline to 105% in 2020, and thus considered to remain within sustainable territory. The EU 10 billion bailout comprised EU 4.1 billion spent on debt liabilities refinancing and amortization, 3.4 billion to cover fiscal deficits, and EU 2.5 billion for the bank recapitalization. These amounts will be paid to Cyprus through regular tranches from May 13, 2013 until March 31, 2016. According to the program, this will be sufficient, as Cyprus during the program period in addition will receive EU 1.0 billion extraordinary revenue from privatization of government assets, ensure an automatic rollover of EU 1.0 billion maturing treasury bills and EU 1.0 billion of maturing bonds held by domestic creditors, bring down the funding need for bank recapitalization with EU 8.7 billion, of which 0.4 billion is a reinjection of future profits earned by the Cyprus Central Bank injected in advance at the short term by selling its gold reserve, and EU 8.3 billion origin from the bail-in of creditors in Laiki Bank and Bank of Cyprus. Given the proposed and actual element of taking deposits as part of the agreement, it was sometimes referred to as a bail-in rather than a bailout.
Criticism.
Irish MEP Nessa Childers, daughter of the country's former President Erskine H. Childers, painted a bleak picture. She described the efforts of the EU-IMF as an incompetent mess and said the Eurozone was more destabilized as a result. In its Schumpeter blog, The Economist called the Cyprus bailout unfair, short-sighted and self-defeating. Specifically, the article says, Dr. Jeffrey Stacey writes on Germany's Der Spiegel, abject error how the Cyprus deal hurts EU strategic interests.
Local reaction.
Cyprus has seen a number of reactions and responses towards the austerity measures of the bailout plan. On November 8, 2012, ERA's Committee for a Radical Leftist Rally, Epitroptomia Rizospostik Aristir Sosperos organized the first protest against austerity and the Troika negotiations that were still taking place. Protesters were gathered outside the House of Representatives holding banners and shouting slogans against austerity. Leaflets with alternative proposals for the economy were distributed in the protest, with proposals including the nationalization of banking, the reduction of the army and the freezing of the army budget, and the increase of the corporate tax. Members of the New Internationalist Left NADA also participated in the protest. On 14 November, the New Internationalist Left organized an anti-austerity protest outside the Ministry of Finance in Nicosia together with the Alliance Against the Memorandum. In the protest, NADA gave out leaflets, which expressed the view that the EU is trying to burden the workers with the debts from the collapse of the bankers and that if this happens, the Cypriot economy and the future of the new generations will then be mortgaged to local and foreign profiteers and usurious bankers. Contract teachers protested outside the House of Representatives on 29 November against austerity measures that would leave 992 of them without a job next year. The teachers stormed the building and bypassed the policemen, entering the parliament. The teachers shouted against the banks and poverty. A protest by investors was staged on the morning of 11 December outside the House of Representatives, with protesters again storming Parliament and bypassing the police. This storming of the Parliament led to the interruption of the discussions of the Parliamentary Committee of Customs. The protesters were asked to leave so that the committee could continue its work, and the protesters left half an hour later. A number of protests took place on 12 December. Members of large families protested outside the House of Representatives against cuts in the benefits given by the state to support large families. Protesters threw eggs and stones at the main entrance of the parliament, and a number of protesters tried to enter the building, but were blocked by the police force that arrived to handle the protest. It was reported that a woman fainted during the incidents. The protesters shouted for the MPs to come out, but no response was given. The protesters were joined by members of KISOA Cypriot Confederation of Organizations of the Disabled, Cypriot Tsunamispondia Organisación and Apron, who marched from the Ministry of Finance to the House of Representatives to protest against cuts in benefits for people with disabilities. Later in the day, members of public school teachers' trade unions protested outside the Ministry of Finance against the cuts in education spending which could result in the firing of teachers. The unions staged another protest the next day near the House of Representatives. Harabji reported that just before bank deposits were blocked, a number of companies belonging to family of President Nikos Anastasiadis have transferred over $21 million outside of Cyprus. Anastasiadis has denied these allegations. Also, a number of loans issued to members of political parties or public administration officers were fully or partially written off.
Analysis.
A team of 16 Cypriot economists, organized by the citizens group Eleutheria Freedom, attributed the crisis to sliding competitiveness, increased